I would not be surprised at $1 million Bitcoin at all. Everything is crashing against Bitcoin. Everything is going to zero against Bitcoin. The world is actually being repriced against Bitcoin. So we get the best of the gold asset class, the best of the cash equivalent asset class created in Bitcoin, and which turns it into this hybrid collateral asset, which I think qualifies it as the most pristine form of collateral in the world.
There's more use cases to Bitcoin than simply buying and holding or trading and speculating with. CJK, founder of People's Reserve, is here to give us his outlook on Bitcoin and explain why that is. Welcome to the show, CJ. Good to see you. Thanks for being here.
Hey, David, longtime listener and fan. It's great to be here. Excited about what's happening to Bitcoin right now. I mean, we're on the precipice, I think, of the maturation of the asset class. We're seeing the monetization of the asset class right now, with it being monetized as digital gold, not only by Bitcoin treasury companies and corporations and institutions, but also even on the sovereign level with strategic Bitcoin reserves. And at People's Reserve, we think what comes next is going to be very similar to what we saw in real estate. They pulled gold off of the backing of the dollar. The real estate asset class became monetized. Michael Saylor likes to call that land banking. But soon after, we saw the financialization of the asset class. Mortgages, mortgage-backed securities, home equity lines of credit, all the financial tools that you need to leverage this asset on your balance sheet to compound wealth. And that's what's so exciting. I think that's what's next for that's what's next for Bitcoin, a financialization of the asset class.
You know, what's interesting to me is that you told me offline you've been buying Bitcoin since $150. That must have been, 13, 14 years ago, 2012? Yeah, so, I mean, before we get your outlook on Bitcoin itself, tell us about how now is different than 12 years ago when you first started buying it. In other words, if you were completely new to the space, what would be your thesis today versus your thesis back in 2012?
Oh, goodness. Yeah. I mean, back then it was just magic internet money, right? Nobody really knew what it could actually truly become. We had hopes and dreams, but we didn't know if it would become a reality. And today, I think what we've seen is not only has Bitcoin evolved from magic internet money into digital gold, but it's really solidified its position as the most dominant asset class in the world. And I think what's really amazing about the asset class is that back when I first started, there was no way to know whether or not Bitcoin would be able to make it through some of those tough and turbulent times. But now, a few cycles in, and we can understand Bitcoin as an engineered money. And what do I mean by that? It's not a natural money like gold. Gold did a fantastic job of storing value through time because as dollars were diluted over time, the cost of the miners to pull that gold out of the ground went up. And therefore, the price they have to ask the market in order to remain profitable and to remain pulling that gold out of the ground continued to rise. So it stored value perfectly based on the natural laws of economics and supply and demand. But with Bitcoin, we have an engineered element. It's like we used to use the horse to get hard work done, but then we engineered horsepower in the engine. And we used to store value in gold in order to protect our purchasing power through space and time. But now we've engineered Bitcoin. It's a strategically designed asset through its computer code that perfectly stores value through space and time. And the evolution into that reality is what's most surprising to me. Starting from magic internet money, evolving to digital gold, and now with the financialization of the asset class, maturing to a pristine collateral.
We're going to get into what pristine collateral means exactly in just a minute. But okay, so you bought way back internet money, magic internet money. There must have been something else that appealed to you in regards to Bitcoin, because if somebody were to present to you magic internet money today, a sane, rational person would probably stay away from it without looking too much into the technology itself, right? So what else attracted Bitcoin to you besides maybe the speculative aspect at the time, 10 years ago?
Yeah, so I did study accounting and finance in school, so I was actually really surprised. I met this guy named Jeff Berwick. He became somewhat of a mentor of mine. He calls himself the dollar vigilante. And I started learning alternative economics. So I started learning things that I didn't pay to learn in school. And a lot of it made a lot more sense than what I was learning in school when it comes to like fractional reserve banking and circulating credit versus commodity credit. The dots connected a lot easier for me when I compared Bitcoin to like a commodity like gold, and then looked at how gold used to be that collateral asset backing those paper liabilities circulating in the economy, and then understanding the differences between a fiat system based on promise versus an actual collateralized system based on proof of work, that intrigued me. And that's really what led me to the bottom of the rabbit hole where I planted some more TNT and went even deeper.
I've interviewed several people in the Bitcoin space. Arthur Hayes on my show said that Bitcoin's going to $1 million by 2028. Jack Mallers shares a similar outlook. What's your reaction to $1 million Bitcoin?
I would not be surprised at $1 million Bitcoin at all. I mean, that's just because that puts it at parity with digital gold. So, I mean, the gold market cap is over $20 trillion today. Gold's been on a rip. And if Bitcoin is digital gold, which it's beyond digital gold because it's an engineered version of the natural, then $1 million to me is just one step along the way. And what I see long term is that Bitcoin is a financial asset. So right now it's kind of being priced as a commodity, as a digital gold. But when all of finance is supported on Bitcoin as a layer zero, and even derivative value is driven into Bitcoin as the base settlement layer, I think we go way beyond $1 million. I mean, it wouldn't surprise me in the long term to see one Satoshi be worth $1. And I don't think we see that in our lifetime, just to be clear. I think that our kids and our grandkids will see that as the inflation schedule of Bitcoin and all of those coins that can be mined over the next 120 years actually comes to a finish. And we're at the top of the S curve of adoption. You know, one Satoshi at $1 could mean $100 million Bitcoin. And that sounds ludicrous today. But when you think of all of global wealth, not just the 1,000 trillion in real world assets, but the thousands of trillions that are in derivative products, all priced in Satoshis and settled on Bitcoin, then we can get to those levels.
Why do you say it's digital gold? The counter argument is that it doesn't behave like gold at all. Just take a look at the price. The price dictates what something does and how it behaves. When gold goes up, Bitcoin has historically gone down, except for a few exceptions in 2021, this year. But generally, gold has behaved as sort of a diversifier against stocks, while the Bitcoin price has traded mostly in line with the NASDAQ. So that's one counter argument. The second counter argument is that gold has historically been used as a store of value by central banks, where Bitcoin has up until now been historically used as an investment vehicle. So, you know, comparing the two are kind of like comparing apples to oranges. How would you respond to those counter arguments?
Yeah, I think those counter arguments make sense if you're following along with the mainstream market narrative. But ultimately, what we have here is a mispriced asset. And that is the opportunity, that the marketplace is mispricing the asset because it's miscategorizing the asset. I would say traditional analysts look at Bitcoin as a risk on tech stock. And that's why a lot of the lending products you see against Bitcoin right now treat it as a stock that you would hold on margin. So at People's Reserve, we want to help evolve it into a pristine collateral. And that's, you know, people ask me, maybe the best way to answer that question is to combine all of it into one answer, which is really this. Why is Bitcoin a pristine collateral? Well, number one, because you're getting the best of gold and you're getting the best of treasuries. What do I mean by that? Gold used to be the collateral asset backing the circulating liabilities, those paper notes within the economy. When they pulled gold off, one of the main reasons was because it's a horrible collateral. Sometimes it would cost more to borrow against your gold than it would to secure it and settle it with the counterparty. Imagine flying your gold across the world and all the costs that come with that. So treasuries and cash equivalents became a better, cheaper, more secure way of settling between two different parties, and you have this T+2, T+3 settlement system that really outpaced gold's use case as collateral. But Bitcoin comes along, and we get the best of both worlds. It updates gold's hardness, which made it a great collateral, to absolute digital scarcity. And then it takes the T+2, T+3 settlement times with easy and cheap settlement and turns it into a 10-minute block time where you can settle billions of dollars for pennies with transaction finality. So we get the best of the gold asset class, the best of the cash equivalent asset class created in Bitcoin, in Bitcoin's code, which turns it into this hybrid collateral asset, which I think qualifies it as the most pristine form of collateral in the world.
If Bitcoin is heading towards $1 million or perhaps even higher, why would you want to use that as collateral for anything? Why can't you just, leave that in your wallet and watch it grow?
Yeah, I mean, that's, I would say that you wouldn't want to spend it, that's for sure. But, a lot of responsible savers of Bitcoin, they're on the right side of the ongoing transfer of wealth. And we're seeing the wealth that has been printed and created in the fiat world transfer and transition into the digital economy, where Bitcoin as the reserve asset of that economy and having the characteristic of absolute digital scarcity without supply expansion, as that value is transferred and goes into Bitcoin, Bitcoin can do nothing but go up. So you are incentivized not to spend it. However, when you think about what a collateral is and how a collateral should behave to empower you through the life of a loan, Bitcoin has some options that no other asset really offers. And what we see, or at least at rates no other asset offers, if you lend your money to the government, they hand you a cash equivalent. Well, because the government is stuck in a fiscally dominant era where they have to dilute that cash equivalent through deficit spending, the value of that collateral, it actually declines over the life of the loan. So as you're holding a cash equivalent and the government continues to deficit spend, your cash equivalent that you're holding as collateral is being diluted over the life of the loan, making the loan actually more risky and actually turning your interest rate in real terms negative, because the rate of inflation, the rate of dilution is actually outpacing the price increases. And that means that you're actually losing in real terms. But when you use Bitcoin as collateral, the opposite happens. The value of that collateral over the life of the loan appreciates in value substantially. The 10-year compounding annual growth rate on Bitcoin is over 80%. The 5-year CAGR is over 60%. 60% CAGR in 5 years means 10x. So if you post Bitcoin as collateral, that it's worth 100 grand. After 5 years, if it maintains the 60% CAGR, it's worth $1 million. Well, the burden of your debt that you take out against that $100,000 at the beginning of your loan is much smaller of a burden when measured against $1 million at the end of the loan. So I like to think of Bitcoin as almost an auto deleveraging collateral. You can post it as collateral, and because it's engineered money designed to increase in value over time, the burden of your fixed fiat denominated debt against that collateral shrinks over time. So Bitcoin therefore becomes like this auto deleveraging mechanism when you use it as collateral. So I would definitely recommend never spend your Bitcoin, especially right now when we're on the precipice of this repricing event. As you said, Jack and Arthur, we all see it going to $1 million pretty easy and far beyond that afterwards. So don't spend it. And if you need to unlock that purchasing power, you should be doing the same thing that Elon Musk does with his super asset, Tesla, or Jeff Bezos does with his super asset of Amazon. They don't sell those shares. They simply borrow against them. And then they use cash flow or investment profit to close the liability. At the end of it, they have their shares and the business or the investment that they made. You get the best of both worlds.
People's Reserve, how does it work? Tell us about the mechanics of this collateralized usage of Bitcoin, and ultimately how people can benefit.
Yeah, so I think the biggest difference with People's Reserve is that we didn't want to just deliver another lending product. We wanted to innovate. And the biggest problem within the Bitcoin lending space right now is liquidation. And that's because Bitcoin is one of the most volatile asset classes in the world. So when the lender treats Bitcoin as a risk-on tech stock that you borrow against on margin, typically, if you're going to borrow $1 million, you would end up going for like a 50% loan to value ratio. So you would post around $2 million of Bitcoin collateral just to get $1 million worth of liquidity. And the reason is that the price of Bitcoin goes down 40, 50%. You're going to get margin calls. And if it goes below that, you're actually going to get liquidated. You're going to lose the most important asset on your balance sheet because of price volatility. So at People's Reserve, we wanted to make sure that we had a way to mitigate price volatility-based liquidation risk. And the way that we've done that is we've introduced variable interest rates. So I like to use the COVID example. If you were borrowing with a traditional lender against your Bitcoin during COVID and the price was at 10,000, a day and a half later, the price is at 5,000, you're getting margin calls. And then that night when price went down to 3,500, if you didn't post more Bitcoin, or even if you posted Bitcoin but not enough, you were liquidated. You were your Bitcoin savings was gone. And just a couple months later, price was right back up to $10,000. So at People's Reserve, that's an unacceptable value proposition in our opinion. So we've created a product that mitigates that risk. So if you were with us during that time frame, and you posted your Bitcoin collateral at 10,000, it goes down to 5,000. The way we've set it up is for every 10% decline in Bitcoin price, 50 basis points is added onto your interest rate. So your interest rate would have went up 2.5 percentage points. You would have paid a month or two of higher interest payments, but then as Bitcoin rebounded and went back up to 10,000, you would have been right back where you were at the original opening of the loan. And you would still, most importantly, hold your Bitcoin. And then even beyond that, That risk adjuster works both ways, not just to the downside, but to the upside as well. So for every 10% Bitcoin goes up in price and then your loan becomes over collateralized, we'll knock off 20 basis points. And we allow a maximum over collateralization of 200%. So you can knock 4% off your borrow rate, which means that if you come to People's Reserve and you over collateralize your loan, you're going to get access to the cheapest cost of capital in the world.
What happens when, let's say, you post collateral using Bitcoin and then it goes down? So the value of your collateral has gone down substantially. Maybe let's say Bitcoin retraces 25 to 30%, which is not uncommon for a cycle. What's required then? Do you have to post more Bitcoin as collateral?
No, you do not. And this is specific to our Bitcoin powered mortgage. And part of the innovation is that we have created a contract that actually cross collateralizes your real estate with your Bitcoin. So even though the Bitcoin price has gone down, still the value of the property is there securing the loan as well. So by cross collateralizing real estate with Bitcoin, we get the best of both asset classes and we get a more secure lender and a more empowered borrower, creating the best of both worlds.
It's kind of an interesting new way to look at things because essentially what we're doing here is we're pricing another asset, in this case, real estate, in Bitcoin, right? Is that where the world is heading towards, do you think, CJ, where everything becomes repriced in Bitcoin? In other words, it becomes a unit of account?
Absolutely. I mean, we're at the store of value stage right now. I think as people start to borrow dollars against their Bitcoin to spend that purchasing power into the economy, we're going to see it transform into a medium of exchange. And then ultimately that leads to it being a unit of account. But whether your listeners agree with this or not, the world is already being repriced in Bitcoin. Something that led to the creation of our Bitcoin powered mortgage product was that I myself bought my house in 2019 for 100 Bitcoin. My wife was pregnant. We were renting an apartment and it was just time. So even though we were at the bottom of a bear market, it made sense for me and it was proportional to my savings. So I bought that home. So, today I walk into my $10 million home, but the problem is it's only worth less than $500,000. So I don't want anybody to get caught paying that Bitcoin up front and giving away generational wealth for one generation of shelter. It doesn't make sense. But yeah, when you look at real estate and you say, how much does the average home cost over the years? Everything is crashing against Bitcoin. Everything is going to zero against Bitcoin. The world is actually being repriced against Bitcoin. And that's because everything else in the world can see the supply be expanded. Only Bitcoin can guarantee absolute digital scarcity. And through its own computer code and the security of that network, which is more computing power than Amazon and Google and Nvidia and all of them added up together and raised to the power of 10, they still don't have the type of computing power that the Bitcoin network has. So it's that digital power that protects Bitcoin's absolute digital scarcity. And with that characteristic, as value is created in the traditional economy and then transferred into the digital economy, the price of Bitcoin can only go up in the long term because the units cannot be expanded. The supply of the asset cannot be expanded. So we see the natural laws of economics actually being leveraged by computer code to empower savers of Bitcoin. That's why we like to call it a savings technology.
Okay, this is a very good concept. It's good in theory, but why aren't other banks following your model? Why can't I go to Chase, Bank of America, or any other bank and say, hey, I like to collateralize my next mortgage with the Bitcoin holdings I have in my wallet? Why aren't they allowing that right now?
Yeah, this is a question I ask myself every day. Why can somebody walk into a bank and make a promise that over the next 30 years, everything is going to work out okay and they're going to work their hardest and they promise to pay you back and they can borrow at 6.5%. But then you go into a bank and you have $5 million of Bitcoin and you just want to borrow $500,000 against it. And they say, no, thanks, we're not interested. Or sure, yeah, that's fine. You can borrow against us 13%. See, interest rates are not just interest rates are the price of money, and the price of money is discovered through the supply of money, the demand for loans, but also the perception of counterparty risk. This is why we have credit scores. If you have a higher credit score, you're lower risk, so you can get a lower interest rate. If you have a lower credit score, you're higher risk, so you have to get a higher interest rate. So risk is a variable within the pricing equation of interest rates or the price of money. And when it comes to Bitcoin, when you use Bitcoin, we call it pristine collateral because number one, it has a 100% recovery rate with a recovery time less than 10 minutes. When you talk about property foreclosures, automobile foreclosures, other types of collateral that are foreclosed upon, sometimes that foreclosure process can take up to a year to 18 months, and the recovery rate is typically 90% or below after accounting for legal fees. With Bitcoin, if something were to go wrong or if a default were to take place, the lender is able to close on that collateral within 10 minutes and almost at 100% recovery rate. So Bitcoin is in the league of its own, and it's really redefining risk. And that's part of People's Reserve mission. Not only do we want to empower responsible savers of Bitcoin to unlock the purchasing power of their savings without giving up ownership, but we also want to redefine the risk-free borrower and the risk-free rate within the marketplace. We believe integrating Bitcoin into traditional financial products will allow us to redefine risk. And when you redefine risk, you can reset price because interest rates, like I said, are not just supply demand, but also risk variables in there as well.
So I can kind of understand the hesitation or the skepticism behind traditional financial institutions. And if I were a banker and you came to me with that proposition, I'd have two questions for you. Number one, how can I be assured, going back to my earlier statement about Bitcoin going down, how can I be assured that the value of the collateral is going to remain relatively stable in a very volatile asset like Bitcoin? Number one. And number two, a lot of banks now are required by law to do their own KYC, so to speak. We want to know that your wealth is acquired through legitimate means. It's not laundered. You're not doing illicit activities to acquire that wealth. The same thing with cash, by the way. You have to buy real estate in Vancouver, where I live. The bank you have to go through a process to prove that your cash is acquired through legitimate means. So the bank will want to know those two things. One, stability, and number two, where your Bitcoin comes from. How would you go about, working with the financial institutions on those fronts?
Yeah, so the first thing is that Bitcoin is completely traceable. So this is probably one of the biggest issues with a lot of people in Bitcoin. They don't like the fact that you have no privacy. But if you talk to the FBI, the CIA, and a whole bunch of other three-letter agencies, they're very happy with criminals who try to commit crime with Bitcoin because everything is tracked and traced. So as far as funds being seasoned, you can look back on the blockchain and see where those Bitcoin came from, even going all the way back to their Genesis block. So if a miner mined a block and it went to a company like CleanSpark, and then CleanSpark sold it to an OTC desk, and then the OTC desk sold it to an exchange, and then the exchange sold it to you, that's all trackable and traceable and confirmed by the blockchain. So I don't think there is an asset in the world that offers more transparency on where it came from and what it was involved in than with Bitcoin. And the X variable to that is the individual person, right? I mean, obviously, when you're filing your taxes and you're making statements about how you're using your money and where it's coming from, you have to tell the truth about that. So that should match up with your Bitcoin records. And it actually is more auditable than cash, is more auditable than some of the other options in the marketplace. So I think some of the banks are just a little bit behind on understanding how to use the technology and how you can map the technology against a person's claims and records to ensure that where they're getting this money from is in the right place that they said it's coming from. And then what was the first part of that question?
Volatility and the loss of the value of the collateral if it goes down. I mean, why not? If a bank were to say to you, CJ, why not just use a stable coin instead if you like the blockchain technology so much? What would you say to that?
Yeah, I think, well, there's two great points here. And the first is that this goes back to Bitcoin being an engineered money. Again, this goes back to them not understanding the actual infrastructure of Bitcoin. So, if you go onto a website like Zillow, you type in an address and all these details come up. But what you might not understand if you're not a developer is that Zillow is plugged into all of these different API protocols that source all of this publicly shared government information across the country. Thousands and thousands of government offices sharing and publishing this data so that deeds can be publicly recorded and that ownership has like a proof of history and a proof of ownership record. Well, Zillow aggregates all of that through their code so that you type in an address and boom, you get all of this information. So I think that's where the banks are right now. The banks are just like the front end Zillow user where they plug in an address and all this information just comes up. They don't understand where the information came from, how it got there, and all the different intricacies of how the software operates in order to present the information in an easily viewable and digestible way. That's exactly what's happening with Bitcoin. And that's why they look at it as a risk on tech stock. When you look under the hood of Bitcoin and you look at the code, what you'll find is it takes the natural laws of economics that have made gold the best store of value over the last 3,000 years, and it engineers them. It leverages those laws for Bitcoin. And what do I mean for that? If the price of gold goes up, it's really going up because there's an anticipated decline in the value of fiat currency. If investors know that there could be some type of trouble, and that type of trouble is going to lead to a lot of printing, right? If some type of war is going to escalate, how do you print? What do you do to pay for that war? You print. There is nothing else to do but print. The United States has almost $38 trillion of debt. They have another $220 trillion of unfunded liabilities. You're going to print. Well, when they print, it dilutes the value of the dollar, it dilutes the purchasing power value of the dollar. What does that do? That pushes up the cost for the gold miner. And any businessman understands that you cannot offer your good or service for a price below your cost. You'll go out of business real quick. You need to ask for a price above your cost. So as those dollars are diluted and miners are paying higher costs, they must ask a higher cost. Therefore, the buyers of gold must bid at a higher price above the cost. And when they do that, that's them actually voting with their money. That's the actual price signal. That's how free market price signals works. This is why capitalism wins over socialism. Socialism tries to state a price and doesn't care about anything else. But price signal is super important, and people vote with their money. And when they're willing to pay a price above the cost, it's them saying, hey, the value proposition I'm getting from this gold is worth the price I'm paying because it's storing my value through time. Well, Bitcoin takes that dynamic and engineers it, because the cost of Bitcoin doesn't just go up because the value of the dollar goes down. The cost of Bitcoin goes up because of the halving. Every 4 years, the amount of coins that miners earn get cut in half by 50%. In other words, the cost of production of Bitcoin doubles every 4 years. There's also something called the difficulty adjustment. Every 2 weeks, roughly, if the hash rate on Bitcoin has gone up, the difficulty will go up, increasing the cost of production. Well, when the cost of production on Bitcoin goes up, the producers of Bitcoin, the miners earning those block subsidies, have to ask for a higher price. And because they can't lose money, they go out of business. So it would be invalidated if hash rate was consistently shrinking. But what we see is hash rate is consistently growing. And that's the same thing you would see in gold mining. Mining operations would consistently grow, right? The price of gold goes up above the cost. That profit gets turned back into pulling more gold out of the ground, and operations expand. Hash rate, so to say, expands. So we're seeing the free market price discovery signal tell us that the value proposition of a truth ledger in a world of lies is pretty high, and we'll pay any price that is necessary to access that truth ledger. Now, do I want to pay massive premiums and pay $1 million to access the ledger? No, because the cost to pull Bitcoin out of the ground or pull Bitcoin out of the block right now is around 85,000. So paying a little bit above that makes sense, because the person who's producing it or earning the block subsidy has to make a profit. So over time, as that grows, this is what has created the higher lows in Bitcoin. We get higher lows in Bitcoin because it's actually a savings technology leveraging these natural laws of price discovery and economics to store value within the network. And that's what I think the banks are missing. They're still treating it as a risk on tech stock. They're still treating it like something that can go to $0. And for that reason, the process of valuing it as a collateral is completely misunderstood. And that's why someone who can go into a bank and make a promise and get a lower interest rate than somebody who's going to post it as collateral and borrow a small amount against a large amount of collateral.
CJ, why use Bitcoin as collateral in this case? If the argument here is that it's pristine collateral because it's beaten everything in existence in its history, well, so has Ethereum and a bunch of other altcoins, right? What's different between, let's just take Ethereum for example. Why not use Ethereum as collateral instead of Bitcoin? Is there fundamentally a difference besides just price appreciation? Which, by the way, Ethereum has performed just as well, if not better, than Bitcoin over some certain periods in its past.
Yeah, so having Bitcoin since 150 to where we are now has been an amazing experience. But I also have had Ethereum since 87 cents.
Sure.
So as I've experienced that growth and I've felt that growth, but there are two critical points here that differentiate Bitcoin from Ethereum. And that is that Ethereum has an unlimited supply. There is no supply cap on Ethereum.
I'm just gonna interrupt you briefly. You're right. You're absolutely right. There's no cap on Ethereum. There is a cap on Bitcoin. However, here's my counter argument. That hasn't stopped price appreciation. Ultimately, as investors, as somebody posting collateral, all I care about is price appreciation. Even though there's no cap, it's a deflationary asset. It's deflating currently, and the price is still going up. So I don't really care that there's no price cap. That's my argument. How would you respond to that?
I would say that that's actually incorrect because at the last peak of the cycle, I think Ethereum was around $4,000 and Bitcoin was around $60,000. And now Bitcoin is over $100,000. And I think the last time I checked Ethereum, it was at $2,200. So Bitcoin's making all-time highs and Ethereum is not making all-time highs. And the fact that its supply is expanded with every single block, regardless of whatever burning mechanisms that they've built into the protocol, it's not actually accruing value. It's not at all-time highs like Bitcoin. It's not moving with Bitcoin because of those underlining what we like to call tokenomics. And on top of that, it's a proof of stake network. It used to be proof of work. It's now proof of stake. So losing that proof of work security and moving to a proof of stake model, as well as allowing for an infinite expansion of supply with a counteractive burning mechanism, the evidence is in the price performance itself. And with Bitcoin at new all-time highs and Ethereum not, I feel much more secure as a borrower posting Bitcoin as collateral, knowing that in the long run, my fixed fiat denominated debt is actually going to be deleveraged against the value of my collateral. Whereas with Ethereum, I mean, what if Bitcoin goes to 1 million and then what? Does Ethereum go up to 4,000? Does it go to, I mean, it's not correlated like it was before. It's not performing the way it was in previous cycles, which is disappointing for a lot of people, myself included, because I've had Ether as a gas to manage my collateral in decentralized smart contracts. Right, so I want to lend from Aave. I want to Maker DAO. I want to use these different Ethereum protocols, and I need to use the Ethereum as gas to execute smart contracts to manage my money, which is Bitcoin. So Ethereum is actually, I think, performing the way it should, which is underperforming against Bitcoin because Ethereum is really a gas to execute smart contracts on its platform. It's not a money, but Bitcoin has been designed specifically as a money, and it's not just only a money. It is the hardest form of money that humanity's ever seen.
So let's sum up. In principle, then, correct me if I'm wrong, for something to be considered hard money, like you say, it has to have a finite cap on supply. Does it have to be proof of work? Can it be proof of stake? It has to be decentralized, and it can't be controlled by any one central authority. Am I missing anything? Do you agree with those criteria?
Yeah, absolutely. And I think proof of work is really underestimated because proof of stake means that you do have the ability to make changes. You do have the ability to switch things around. I mean, Ethereum went from proof of work to proof of stake, and then it was found out that they wanted to add the burning mechanism because of the constant inflation. So there's been a lot of instability in Ethereum's protocol. Whereas when you look at Bitcoin and the changes that have happened over time, people have tried to make changes, but never to the core. They were forced to fork off and to provide a digital power source of mining groups to facilitate the power to secure that network. But when you look at Bitcoin network relative to all those different forks that tried it a different way, they've all become worthless. They're all worth nothing, and Bitcoin Core has held the course. So you can't make changes to Bitcoin Core as easily as you can to an Ethereum. And part of that is having proof of work consensus mechanism versus proof of stake. Because in proof of stake, the people with the most coins make the decisions. But in the proof of work, it's a combination of node runners and people who really care about the network, as well as miners who are putting together blocks, obeying that core code to win the subsidy that actually has value for the costs that they're paying to earn that subsidy.
There's roughly, 900 Bitcoins mined per day. So I believe, and correct me if I'm wrong, but I believe there's more Bitcoins acquired on a daily basis by MicroStrategy, BlackRock, Fidelity, and all these other funds acquiring Bitcoin for ETFs than there are being supplied on a daily basis. In other words, there's more supply taken offline than being minted. So is it still a decentralized asset going forward is one of the arguments or concerns that people have.
Yeah, it doesn't really matter who owns the Bitcoin, again, because it's not a proof of stake network. So the ownership of the network doesn't get you anything. It doesn't get you a vote. It doesn't get you power over the network or power over the miners who are supporting the network or power over the nodes who are contributing to the consensus mechanism.
Are you concerned that whales are now going to be, it's going to be easier for whales to move the price because they've accumulated so much relative to what happened 10 years ago, for example?
Well, I think a lot of the people that are getting involved now, a lot of the institutions that are getting involved now are actually market makers. So I think very few entities are pulling a Michael Saylor and actually getting long on Bitcoin. A lot of entities are just looking for exposure on Bitcoin. And what do? They buy Bitcoin spot and then they turn around and short it in the futures market and they become delta neutral. And so, as the value of their, let's say the price of Bitcoin goes up 10%, well, the value that they bought in spot goes up 10%, but they sold an equal amount short. So as the value goes up and people become more and more bullish, they're willing to pay a premium for that short. Much like options writing, when market makers are selling calls and puts, they're pulling premium out of the marketplace by people who are trying to speculate or hedge their portfolios. That's what I think we're seeing right now. A lot of this buying demand, very few of it comes from people like Michael Saylor who are long-term levered long. Most of it comes from delta neutral market makers who want exposure to the asset class because, as I said before, it's one of the most volatile asset classes in the world. And when you talk about options, volatility equals higher premium. And premium is the definition of their yield. So as they yield harvest volatility, there's no other asset class that compares to the yields that you can get as a market maker in Bitcoin because there's no other asset class that demonstrates the volatility that you see in Bitcoin. So even though a lot of coins are being bought, I think the futures market offsets those buys. We're seeing a lot of people come in as market makers looking to farm volatility and yield farm the options premium and not necessarily get long on Bitcoin the way we see Bitcoin treasury companies doing it.
Hypothetically, what could, in theory, wipe out Bitcoin's value such that it becomes almost worthless and not useful as a collateral or anything else for that matter?
I think it's all the same things that apply to gold and dollars. I mean, a complete breakdown of the social contract and society itself. But again, what good is having a bank card if the internet doesn't work? Most dollars are digital today. They're not physical cash. And what good is having a bunch of gold if you can't walk down the street with your kids to the park? So I think a breakdown in the social contract, a breakdown in the internet economy, all of these things would not just affect Bitcoin. They would affect life as we know it. And those are the only reasonable things that I think that and it would be unreasonable to assume that people in the world would be okay with those things happening. Nobody wants to see a breakdown in the social contract. No one wants to see World War III. No one doesn't be able to take their kids to the park on the corner safely. Nobody wants a Mad Max scenario, but of course a Mad Max scenario would affect all types of assets, not just Bitcoin.
Okay, excellent. A very good introductory interview on the People's Reserve. We'll follow up next time on more news and updates. Where can we find out and learn more about the People's Reserve in the meantime, CJ?
Yeah, you can just go to peoplesreserve.com and sign up for our newsletter. We don't just teach you about Bitcoin. We teach you how to use your Bitcoin in tandem with our Bitcoin-powered financial products. And again, to unlock the purchasing power of your Bitcoin without giving up ownership. Of course, you can follow me on X at CJ Constantinos and People's Reserve at People's Reserve.
Okay. Thank you very much. We'll put the links down below, so make sure to follow CJ and the People's Reserve there. Appreciate it. We'll speak again soon.
Thanks, David. Looking forward to it.
Thank you for watching. Don't forget to like and subscribe.